Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with industry veterans Michael Hartzman and Dominic Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominic Tavella and Michael Hartzman.
All right, I'm Michael Hartzman on the Lebenthal Report. Tonight, sitting in for Dominic Tavella is Andrew Gilmartin, CFP and Director at Lebenthal Wealth Planning and a colleague of ours. And a friend of the show, on for his quarterly appearance, Jeff Oak. He is a Vistage chair of 5 groups, 4 on Long Island and 1 in New York City. And welcome to you both, gentlemen.
Delighted to be here, Michael.
Likewise.
Dom will be so pleased that his presence is so powerful. I needed 2 of you guys to open the show rather than my normal intro with just Dominic. So let's get into the numbers like we normally do. Last week was not a great week for the market. There was the continued worry about the war in Iran running up again. Oil spiked as a result of that. And, tech earnings were not perfect. And it seems to me that tech earnings have to be perfect these days, especially with all the money that's being spent by hyperscalers on the AI build out. So last week was a little bit of a rough week. The S&P was down 1.66. The Dow was down 1.58. And the NASDAQ, as usual, when things get rough, the NASDAQ usually takes on the chin the most, was down 2.88% quarter to date, which is, all of July and really for this report, it was all of July. The NASDAQ has been down over 4%. So the NASDAQ has definitely taken it on the chin a little bit here, Andrew. But the earnings, as I said, they're not perfect. But a lot of these companies, they're pretty darn near close to perfect. And Wall Street still has set some expectations sometimes, which I think are hard to manage.
Yeah, and I think before I comment on that specifically, had we been having this conversation last week, it might have been a little different because of such a dramatic turnaround or rebound in the NASDAQ. Since its highs up until last Wednesday or so, I think the NASDAQ was down about 9%. Now we're down maybe 1 or 2% from those highs in early June. But like you said, tech usually takes it a lot tougher when there's a pullback. And I think part of that is these companies not being perfect and maybe the fear of CapEx spending becoming more prominent. Something we've been talking about a lot more recently is the amount of leverage in the market. And usually when you have a lot of leverage and you face a pullback, that pullback tends to be a bit more dramatic than it should be. And when you and I spoke late last week talking about just what was going on, there was no fundamental thing that we could point to that kind of caused this pullback. But, as earnings season has been going on, banks did really well, and then tech was next on the lineup. And if they're not perfect, we've seen that they get beat up. Before the show, we were talking about SpaceX and its first earnings report since becoming public. And year over year, they grew revenue nearly 100%, almost doubled it. And after hours, they're getting beat up. So a lot of volatility.
Yep, a lot of volatility. And you used a great word this morning on our morning call with our advisors. My opinion is it's an SAT word. You said the market has been parabolic. So kudos to you. That's definitely the word of the day. And, the NASDAQ is up 83% cumulatively over 3 years. So I don't know the exact definition of parabolic and what would qualify, but I think 83% over 3 years, no one would sneeze at, and that would definitely fall into that category.
I would agree with you on that. And I think, again, another reason why the pullback was a little more pronounced than it may have been. You see some companies up 60, 70, 80, 100% year to date or over the last year. And when you look at the NASDAQ versus the S&P over that same time frame we just looked at, beginning of June through the end of July, the S&P was only down, roughly 3% versus the NASDAQ down about 9% from those highs. And I think that just spoke to the breadth of the market right now. And a lot of sectors are doing really well. And the names that we hear pretty much every day ran up a little too much, came back, add in some leverage, and they come back a little further.
Yeah, and you look at the top 10 sectors, the top 11 sectors year to date. I'm going to discount energy because energy having a great year is clearly a result of the war in Iran. But industrials are up 18%, real estate is up 14%, materials are up 10, utilities are up 9. And I think a lot of that, and I left out technology on purpose, which is up 16. But even if you look at industrials and real estate and materials, you could almost make an argument that they're also tied somewhat to the build out in the AI infrastructure. And really the worst sector is consumer discretion and communication services. Consumer discretion is down 7, and communication services is down 4. And we're going to get to consumer discretion a little bit when we talk to you, Jeff, because that may be a part of what's quickly becoming a K-shaped economy, where consumer discretion are people buying things they don't necessarily need but necessarily want.
Yeah, I think when people look at their accounts and they see that they're up more or less no matter what they're invested in, aside from a few other investment types, i.e. Bitcoin, they feel like they can spend, and there are underlying things that could hurt the economy. Inflation's still relatively high to its baseline. There are certainly geopolitical fears around the globe that could add to curbing spending, but people still spend. And it's going to be interesting to hear how small businesses and their leaders are reacting to what's going on in the market right now.
Oh, look at you, your third show, and you set up a nice segue for Jeff. Nicely done. So, Jeff Oak, how are you?
I'm well, Michael.
Good to hear. So, for our listeners' benefit, Jeff is a Vistage chair. He works with Long Island CEOs, business owners, and people's part of, as you would say, Jeff, I've heard you say it 1,000 times, the C-suite. Those who are hungry, humble, and smart. So Andrew and I are in 2 of your groups. So hopefully we fall into at least 2 of those 3 categories, Jeff. Hopefully we get the hat trick, but you're the one who determines that.
You definitely get the hat trick. You definitely get all 3. You definitely get all 3.
Thank you.
Yeah.
So Vistage was founded in 1957. It's the world's largest CEO coaching and peer advisory organization. Today, with 45,000 members, as I said, Jeff, Andrew, and I are 2 of them. So, Jeff, welcome to the show. Welcome back. We always look forward to this. And as Andrew mentioned, you're going to give us an overview of the most recent CEO Confidence Index, which I think I got my email yesterday. So this literally is right off the presses, isn't it?
Yes, it is. It's based on data in the first half of June, but of course it takes time to process and whatnot. So the report itself is quite new, quite fresh.
And there's a couple of takeaways from there, Jeff, and I'm just going to go through some of the notes that we gleaned, and really just right from the very top. The index declined 3. This is quarter over quarter, not year over year, correct?
Yes, quarter over quarter. Yep.
Okay, so quarter over quarter. So the last 3 months, and this would be the 3 months that the war in Iran started, because there's a little bit of a lag with this data.
Yep.
The index declined 3% from 87.2 to 84.2. I mean, I look at that number, and to me, it's kind of so what? I mean, that's not really a big decline. Would you agree, or would you think that's I'm misreading that takeaway?
No, I would agree. I think it is a modest decline in our in our index. A 3-point swing in either direction is modest. It's in the downward direction, but where it ended up for Q1, which is what, I'm sorry, Q2, which is what this data is for, that really brings us to a level that's comparable to the 3-year average. So we're basically average based on what this index has shown us over the years. I would describe it as a reset, not a collapse.
Okay, well, and Andrew, let me just ask him one more question about this, then I'll give you a turn. What I was really more struck by, Jeff, is the pre-COVID 2010 number was 97.8. Is that correct? That CEOs were that optimistic in the 2010s?
That is correct. That is correct. Yeah, it is. It is correct. There were some businesses during COVID who did well, a lot that didn't.
Mhm.
And the society was a mess, but there were businesses that did well.
But that was a pre-COVID number, Jeff, according to this.
I'm sorry, yeah, pre-COVID. Yes, 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 yes.
Okay. All right. Andrew?
When we're interpreting this reading, what's the data that goes into it? Is there data that should be weighed more or that is weighed more in kind of dissecting sentiment from these CEOs and these business leaders?
Yeah, I think it's a great question, and I think level setting is always a good idea when we have this conversation. These we survey small business CEOs. So these are people who are running small and mid-sized companies. They are making decisions in real time, and the questions probe. So how are you feeling? Are you optimistic? Are you cautious? Are you pessimistic? Are you inclined to invest? Are you pulling back your investments? Do you expect to be hiring a year from now or a month from now? Have you pulled back on your hiring? And it's about the sentiment or feelings of the leader. There are behavioral economists that will say, and a lot of research backs it up, that humans, we make decisions based on emotion much of the time. And so these leaders are making decisions based on their sentiment, their level of confidence. If I'm feeling confident, if I'm an athlete and I'm going onto the field feeling good, I'm going to play a certain way. If I'm not feeling confident, I'm going to play perhaps more defensively. And I think that's an appropriate analogy for these leaders. Um, and in terms of the things that go into it, we're querying on a whole range of things what they believe the recent economy looks like, which direction is it going in, what the future, the longer term economy, which direction do they feel it's going. We ask questions relating to their revenue projections and their profitability projections, two very, very important dimensions, and questions about their investment plans and their workforce plans, whether they're hiring or not. Those are really 6 fundamental dimensions that we always query CEOs about. And then Vistage typically adds some questions that focus on a particular dimension, whether it's AI or hiring or strategy. So we generally try to put in a focus area that digs a little deeper on some of the metrics that maybe are not quite so central to every single report.
So, Jeff, the criteria that Vistage lays out are small to mid-sized businesses. So, what's the definition of that?
Well, the Small Business Administration defines a small business as $1 million to $1 billion. Our sweet spot is generally between $1 million and I think 350 or 400 on average. The last time I checked, the mean average revenue of a small business In Vistage is about 30 to 35 million.
Okay. So the takeaway from the confidence index on the broad strokes number is, I think, what you and I touched on. It's that it's not a confidence collapse, it's a recalibration, correct?
Yes, yes, a recalibration, um, and a recalibration in confidence. It's like, okay, I gotta adjust my expectations here.
But still, 84% is still relatively high. That's more than 8 out of 10 participants.
Uh, yes, and so that number of 84 is not the per, is not the per, that's the number for the index. It's
Okay.
not to suggest that 84% um, are fully confident and whatever 16% is, like not confident. So that's really the index swing more so than the percentage of CEOs, who are positive on that particular item. So you got to be,
Gotcha.
because sometimes the numbers go above 100. So
Gotcha. So that's a compilation of the
correct,
data you've
correct.
collected.
It's
Got it.
truly an index.
Got it.
It's an index of a variety of measures.
I'm glad we cleared that up.
Yeah, yeah.
And so when looking through this report, it seems like the standout topic is inflation, and I think that is true as one of the things when we look at the stock market, financial markets, and how we're going to invest. Um, it seems like today, the CEOs, the leaders are generally not so optimistic, but looking forward maybe 12 months, 18 months from now, they're feeling more optimistic, even though they expect inflation to trend higher. Is that accurate? And if so, um, what's driving their optimism
Yeah.
outside of inflation?
Yeah. So the inflation number in this quarterly period um, reflects that inflation reached 4.2 percent in May, and nearly all small business owners expect higher costs. Three-quarters of them are seeing some increases in customer price sensitivity. So that's causing just some uneasiness, some level of caution.
It's hard to
Um,
plan.
it's hard to plan. It's hard to plan. And in contrast to much larger companies, small businesses, when they're squeezed, they need to respond sort of quickly. They don't have a lot of time to steer the boat slowly, but they really have to um, have some agility. And if they wait too long to adjust their prices due to inflation, they're going to sacrifice margin. But moving too quickly can negatively impact demand. So there's a fine line in navigating that sense of caution relating to inflation.
When you bring up inflation and just looking at what CEOs are expecting, they're expecting the economy, 19, the economy to get a little worse. They expect their own revenue projections to get a little worse, profitability to get a little worse, and even their workforce plans are not as robust. They're down slightly, not as robust as they were. I think a lot of that might be attributed to Jeff, as a lot of business owners came into the new year expecting interest rates to go down.
Yeah.
And so if interest rates are going to stay the same, which I think we believe is likely, Dom and I don't know, Andrew, wonder what you think about that, but and it might even go up, which I personally don't think will happen. So that affects CapEx spending, their ability to refinance. So would you think that, not only inflation, but interest rate projections would also create some of the cautiousness of these CEOs?
Absolutely. And while the tariff situation is not as chaotic as it was 6 months ago, say, there's still some uncertainty introduced by, okay, are companies going to get their get their tariffs back, or how's that going to work? So yes, I believe interest rates. I think the the tail connected to tariffs is still, kind of playing. There's certainly a level of uncertainty. I mean, you would know, as you two would know better than anyone, that the market, the economy doesn't like uncertainty. And you point out, of the six key measures, Michael, you called attention appropriately that four of them are down as compared to last quarter. What's ironic, and it's a little bit of a head scratcher, is that their confidence about the future economy has gone up. So go figure. Go figure.
Well, that's the Jeff. That's the DNA of every business owner in the world.
Yeah, good point. Good point. It's
Was
going to
there
get
anything,
better, right? It's going to get better.
if you don't have that outlook, it's going to be hard to stay in business,
Yes, yes.
right?
Yeah, yeah.
Is there anything that surprised you? You know, the number came down slightly. You said it was kind of a recalibration of the average. Is there anything that stands out to you in this report?
Well, I think something that's very notable, I think, for business owners, and we were talking about this before we went on the air, is just to highlight that this data suggests a K-shaped economy. And just for your listeners, imagine a capital K on a graph. There's one line that goes up and there's a line that goes down. And if we simply look at the average, it may give us of the two, it could give us a misleading picture. Small business owners have to look at which line of the K is their industry in. Is it on the upward growth line that's showing a more positive future, or is it the downward line that's showing the opposite? It's not sufficient to simply look at the average. The segment that you're in matters more than the headline for this particular metric. That's one thing that really stood out to me, that helps to make sense of some of the data that we're seeing here. The average can look stable, but the underlying experiences of companies and industries are dramatically different.
We talk about the K-shaped economy all the time with clients, and I think from our point of view, we're dealing with a lot of individual investors as well as business owners, and the wealth effect of the stock market, Jeff, also has created a bit of a K-shaped economy where if you have a 401k, you have money in the market, you'll complain about the high price of gas. You'll complain about how expensive things are when you go grocery shopping, but you're going to buy everything you want anyway. The bottom half of that K, they are generally affected by inflation and by higher gas and by higher prices in general. And I think that's something this administration was grappling with, I don't think particularly successfully, earlier this year. So to your point, if you're a business owner, focusing on that bottom part of the K, how do you make your adjustments?
Well, that's a great question, and it's a very complicated one that I think, when we talk about the other call outs, as we go through the conversation this evening, I think we'll shed some light on it. So rather than trying to get into that kind of all at once right now, I do think that's really where I think the conversation lies when we dig into these, the details relating to the importance of planning and execution, a little bit more about inflation and pricing, and margins as a topic, how hiring, investment in AI factors into all this, and then what should business owners be planning? What should their playbook be going forward?
So just focus on AI for a second. Where, how do you think? And I know everyone's spending more and more money on AI, but where do you see so I guess, is not the boogeyman when it comes to all of this. AI could be your friend, and you could benefit from AI if you choose to. Correct?
Right. Sure. Sure. I think one way to think about AI is through the lens of the workforce. There's a lot of conversation about how many jobs is AI going to eliminate, and I think it's actually more helpful and more accurate to say that the workforce is being reconfigured, not simply reduced. Um, you need people with AI aptitude to do stuff, to leverage those those advantages. Um, CEOs generally are not shrinking their workforce, but they are redesigning it.
Yeah.
And they're
But
designing it in certain particular ways. And I know, just as a Vistage chair, I'm a solopreneur, but I have there's a lot of administrative stuff behind the scenes, and it's yours truly, doing it. And I find that I'm working differently
mhm.
as I leverage AI. The work is redistributing as I become, more efficient in one area. Then it gives me opportunity to apply those efforts in another area. And I think work itself is being redefined.
And look, the world economy has gone through these transitions many times before. We all know the story. The automobile replaced the blacksmith, electricity replaced the candle maker. So, humans are resilient, and will survive this transition as well.
Yes, yes, amen.
So let's take a break right here, and then we'll get into some of the other bullet points on the other side with Jeff Oak. We'll be right back.
You are listening to the Lebenthal Report. If you have any questions or comments, please send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my colleague Andrew Gilmartin, CFP and Director of Lebenthal Wealth Planning, and Jeff Oak, friend of the show and frequent contributor. He's here again tonight to talk about the Vistage CEO Index. Andrew, I'll turn it over to you.
Sure, thank you. So, Jeff, we've been talking about a lot of moving parts for small business CEOs, leaders, and it seems like when it comes to them planning for their business, whether it's for the next quarter, over the next year, it seems like not only do they need to be more agile, but they need to think maybe in shorter time horizons, given how fast things can change. So walk us through, what's going on in their minds when it comes to planning in an
Yeah.
environment like this.
Yeah, thank you, Andrew. And one of the things that I like that I always kind of go to when I'm analyzing any kind of data is the what, the so what, and the now what. The what is the data. The so what does the data mean? And the now what is what do we do with it? What actions do we take? So I just want to keep that framework kind of in the background here. What the data tells us is that an awful lot of CEOs describe strategic planning challenges. They're struggling with stuff. And the data further shows that the dominant obstacle, the big obstacle, wasn't creating the plan, it was executing it. So that's what the data says. What does that mean? What it means is that strategy in itself creates no value. It creates value only when people are making different decisions and taking different actions. And our recommendation from an action standpoint for leaders and executives is to make the execution element part of the strategy itself. To put it differently, a strategy you can't execute is not a strategy. It's a wish list. And there are a lot of wish lists in companies, and they want to get to the execution. Why are CEOs saying that strategic planning is challenging? Well, it's what we were talking about in the first half of the show before the break, is the uncertainty. And when there is uncertainty, that shouldn't be a reason to stop planning. It's every reason to shorten the planning cycle. So rather than looking out 5 years, look out 3, or if we've looked out 3, look out 2. If we've looked out 2, look out 1. Shorten those cycles in order to provide meaningful guidance on, what are the decisions and actions that we as a company want to take. And there's a whole bunch of specific tactical things that we can go into if you want to. But I think at a high level, those are the thoughts that I would share, Andrew, as it relates to the relevance of strategy as the data's the picture that the data is showing us in this survey.
Look, Jeff, you're a business mentor, you're a business coach. I'm in your small business group. Once a month, we get together with some really smart, really successful business owners. They're all my friends. I love them all. But they're also, I'm part of that. We're also the chief cook and bottle washer frequently.
Yes.
And I think part of the advantage of being in Vistage is you're able to point that out, right? You're able to say, well, you can't be the traffic. You can't implement a strategic plan and have your day blow up at 9:30 in the morning because 3 things have now landed in your way that you now have to deal with.
Yes.
So I think part of, when any business owner wants to put in a strategic plan, they have to be able to bifurcate, who's going to be the traffic cop and who's going to be the strategist. Is that correct?
Yeah, no, I love the way you teed that up, Michael. What you were describing, in your earlier comments is, when things blow up in the morning, the biggest challenge I see in small businesses is how difficult it is for many leaders to work on the business, um, instead of working in the business. That what happens at 9:30 is you gotta, there's a fire, you gotta put it out right away. And that's why I have such enormous respect for small business owners and really admiration is that they get pulled into the weeds, given the size of their business and the nature of the business. They get pulled in the weeds all the time, which makes it difficult to pause and to step back and work on the business. And that's why we meet for a full day once a month to sort of create that pause, to create the space to reflect, to look at the big picture, as we sometimes say in our group meetings, to get off the field of play and go up to the balcony where you can look down on what's happening in the game and develop plans and strategies. A plan, a strategic plan isn't just a document. It really represents a cadence for decision making, for making commitments, and hardwiring accountability. So it's very difficult and very important for leaders to take the time to develop a strategic plan.
And I think that's planning at the macro level, right? And we can drill into a million different things at the micro level for planning. But something you mentioned earlier is that these leaders are seeing revenues grow, but profit margins shrink.
Yes.
And a big reason for that is inflation. How do small business owners, and maybe it's regardless or not regardless of which industry they're in, how are they planning for price adjustments, passing on costs, increasing profitability for their companies?
How they're doing it is carefully. I mean, it's very hard to do, I think the first thing is a mindset shift that, yeah, revenue's important, but profit is the scorecard. I mean, if revenue's the name of the game, profit is the scoreboard. So recognizing that rising top line, but a stable profit line could actually suggest that growth is costing you. And just recognizing that and remembering that is critically important for owners. So that's a big mindset shift for some. Everybody likes, yeah, we made more money this month, or we had more top line revenue this month, and everybody cheers. But you really that's really not the number. That's like looking out and saying, yeah, they're playing soccer, but what's the score is the key question.
Well, if it's soccer, it's probably 0-0, but that's another conversation.
Right.
I don't want to offend a billion people. So maybe we'll have Larissa edit that out.
Yeah.
Yeah. But to your point and Andrew's point, Jeff, in the report, in real time, it was interesting to me. CEO's optimism slips below 50% in Q2, dropping three points from last quarter, and 34% believe it'll remain the same, and 48% believe it'll get a little better. But looking ahead 12 months, the number jumps from 48 to 64%, and the worsened number goes from 17 to 10, who gets back to what we said earlier. I think inherently business owners, and yes, you have to be realistic, but you also have to be optimistic about the business you're in, or it's doomed to fail, isn't it?
Yes, yeah, for sure. I think Michael Porter is sort of the guru of strategy, and I think one thing that he said that I return to in my own mind, all the time. The most important decisions in strategy are not what are we going to do, but what are we going to stop doing? And
Hmm.
Porter says the most consequential decisions in strategic planning are the decisions around what we're going to stop doing, in order to make sure that the scorecard, the profitability, goes in the right direction, that it's not just top line revenue, but bottom line. And I love Porter's quote, not only because it's memorable and a little bit counterintuitive, but it's so true. I mean, how many times we say we're going to do more, we're going to do more, we're going to do more, but nobody says. Oftentimes, nobody says, "Well, what are we going to stop in order to do A? What are we? What of these remaining things are we gonna step away from, or pause, or stop doing?"
Yeah.
Is there a common theme amongst leaders about what they're going to stop doing or what they're going to pivot away from?
I think it all depends on what the business is. I think sometimes CEOs, they look at a customer they've had a while and they'll say, that's a great customer. We've had them a long time. But sometimes they don't look at how costly or time intensive that customer is, or whether there's good profitability from that customer or mediocre or poor. So I think sometimes CEOs are not looking, they're not always sort of peeling back things, peeling back the onion to really look at, is this a customer that brings value? If they don't, then maybe we keep them, maybe we don't. But just knowing those things, it really varies industry to industry. What are the things that they need to look at, that are candidates for stopping doing? I think legacy services, they've been around for a long time. Maybe they're no longer delivering the results that they once did. Um, so I think it's a whole variety of things, Andrew.
Yeah, I mean, and that, the nugget takeaway that you gave us is growth may be getting more expensive.
Yes, yes. That's when top line revenue goes up, but profitability remains stable. That means growth is more expensive.
And to your point, it could also be you focusing on the wrong clients or high
Yes,
maintenance clients.
yes,
It's like
yes,
that rule where 80% of the outcome comes from 20% of
yes,
those involved.
yes.
Yeah.
Yeah, yeah, yeah. And I think, you know, one of the key things that we've sort of touched on, but I think might bear some little further discussion here is pricing. So we've got inflation that's in play. That's been a theme in a number of comments that we've discussed. And with increases in inflation, CEOs face a squeeze. If they as we touched on earlier, if they wait too long to adjust prices, that can diminish margin, but moving too quickly can really compromise customer demand. And so just like, or similar to the earlier discussion about strategic planning with more uncertainty, um, small business owners do well to consider shorter planning cycles. I think a similar thing could be said about pricing, that with more volatility, with more uncertainty, making pricing decisions more frequent and more segmented. Maybe we don't raise all prices, but we raise certain prices. That we maybe don't do an annual increase, but we look at twice a year or once a quarter or as needed. So there's a level of that notion of shorting, narrowing the cycles from a strategic standpoint also applies, shortening the cycles for pricing increases. Really, a lot of value in considering that.
Jeff, once a show, you always tell me that Dom and I throw you one or two curveballs. So here we go.
Okay.
I'm looking at some of the concerns business owners have, and quite frankly, they're the same concerns they had a year ago: tariffs, inflation, the high cost of doing business. Um, does Vistage ask, or do CEOs bring up voluntarily the high cost of benefits, the high cost of health insurance? I own a small business. I get a letter once a year from my health care provider that they're raising my premiums by 15 to 20%. That letter annually,
Yeah.
annually. My employees expect a 401k. My employees expect me to continue to increase their paid time off. Um, I don't frequently see, and I'm going to call them complaints by the wrong word, worries, concerns, pressures on the business. Are these things brought up, or are these issues that just always remain in the background that small businesses just are resigned to deal with and factor in?
Well, let me answer that in two ways. In our group meetings, our monthly group meetings, Michael, that you're very, very familiar with, and Andrew, you're familiar with as well. We process issues, and it's very common that an owner will say, "Hey, I really need some advice and suggestions from the group relating to my health insurance plan or some of these other
Mhm.
expenses." Um, I think something like health insurance and 401k, two examples that you alluded to, in many instances, those are embedded in the cost of labor, so that they're not specifically called out, but they're embedded in other numbers. And so that would be my answer. Absolutely, it's a really big, big, big factor as you rightly point out. Um, and often it's loaded into the cost of labor.
Speaking of employees and colleagues, hiring, about half the CEOs in Vistage say they plan on hiring going forward. Is that historically in the average? Is that high? Is that low? Um, what's your take there?
I think I don't have that information right in front of me, Andrew. But if we looked at 3 years worth of the confidence index, so 12 quarters, we could isolate that one item to see where those, and it would be in the of the six core domains that we include in the survey. In every survey, it would be in the workforce plans. Are CEOs planning to expand their workforce, or reduce it? So I don't happen to know those long-term trends on that particular domain. I will say that for this quarter, 38% of CEOs plan to increase, fixed investment, which generally means people. Um, Leaders, based on this cycle, this Q2 of 2026, it shows that leaders, are not abandoning growth, but they're becoming much more selective about capital and talent. Hiring, based on what CEOs are telling us, is increasingly tied to revenue or capacity. How do we increase those things? While AI and other automation tools are increasingly being seen as ways to, um, where we might otherwise have to increase headcount, perhaps machine learning can help us take care of some of those tasks through automated tools as opposed to people doing it by hand. I think for every role in a company, identifying the work that requires independent judgment and the work that can be augmented and the work that can be automated. Those are very different types of work, the independent judgment, when we're supplementing the workforce that we have, and then the work that can be automated. And I think leaders do well to clearly define the business case for all three of those kinds of hires. So they all represent talent, if I can put it that way. Machine learning, talent might not be the right word, but it's a resource for getting work, certain kinds of work done, to really think strategically about three different kinds of work that gets done in companies now.
Jeff, what I found interesting is really in the very beginning of the report, where 50% of the participants were either manufacturing, construction, and wholesale trade. So those are not work from home occupations, right? Those are kind of get your hands dirty, manufacturing, construction. So when these CEOs, these are business owners that are really building stuff in real time. And I can understand why their sensitivity to the economic ups and downs would affect them more so than a CPA company or financial services or banking. These main sectors that you guys are talking to really are in the trenches.
Yes. And let me just share a high level of a conversation I had today with a member in one of my coaching sessions. This person is in a consulting type business, and was telling about some work that they were doing at a very, very, very large farm in Oregon. And he was describing these gigantic threshers that were doing massive work. Some of them were zapping weeds with lasers. They were calibrating how much water they're spreading based on how big the plant is or how small the plant is, how warm it is, how damp it is. And every single one of these gigantic machines on wheels going through fields, not a single one of them, that's hands-on work. Not a single one of them had a human being in it.
Wow.
So machine learning takes many, many forms. And you're right, there are some industries where there is a person handing a product or a service to another person, and you can't automate that. Perhaps you can modify, perhaps you can leverage machine learning for the things that lead up to it. But there are, in fact, as you say, many businesses that require people doing stuff with their hands, their bodies, manipulating, manufacturing, et cetera.
And I think, within those traditional type sectors where maybe machines are taking over more businesses, just because the machine is taking over a specific role doesn't mean the construction of that machine isn't opening doors or avenues for other jobs in a separate
Yeah,
part to
great point,
support that.
Andrew. Yeah. Programming it, monitoring it,
Right.
and as well as designing it. So yeah, that's where we talked about the reconfiguring of the workforce. It's being redesigned. I never when this person was describing detail after detail after detail of all these things that were automated, I was thinking farming, that's like people, that's a lot of hand, that's a lot of, that's a lot of human beings doing stuff. Well, yes and no. I mean, the examples that they were providing were quite stunning in terms of how automation has advanced in certain industries.
Jeff, to put a bow on our conversation tonight, I'm just going to quote the last nugget that you call the closing nugget, which I love. You cannot control the economy, but you can control the quality and cadence of your decisions. What do you mean
Yes.
by that?
So we're big. I'm very big in all the groups, reminding CEOs, remember what you can and can't, what's in your control and what's not in your control. And the economy is obviously outside of our control. But what do we control more than anything is our decision making, both the quality and the timing and the cadence of those decisions. And I think that applies to all the topics we talked about, that with respect to the K-shaped economy, know which part of the K your industry is in and make your decisions accordingly. Use your decision making to protect profitability in a time when inflation is still and interest rates are still very, very much issues. When you think about your strategic plan and your execution, shorten the planning cycle. These are all action items. Invest selectively, and integrate talent and technology. These are all decisions that are completely within the control of the business owner, and that's where our energy and focus and time should be directed, is the things that are within our control.
Jeff, thanks again, as always, for making the time every quarter to go over the Vistage CEO Confidence Index. We'll see you again on the podcast in 3 months, God willing, and Andrew and I will certainly see you before then.
My pleasure. Thank you for inviting me, Michael. I love this time each quarter.
Great to see you, Jeff.
Take care, Andrew.
All right, so we'll be back again. We're going to take next week off. We'll be back in 2 weeks with a new edition of the Lebenthal Report. Have a good night, everybody.
Thanks for tuning in to the Lebenthal Report. Dominic and Michael will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week. The Lebenthal Report is brought to you by Lebenthal Global Advisors, LLC, a registered investment advisor, and Lebenthal Financial Services, Incorporated, a FINRA registered broker-dealer. This podcast is for informational purposes only and should not be considered investment advice. The views expressed are subject to change based on market conditions. For more information about our qualifications and business practices, visit our website, lebenthal.com, where you'll find links to SEC's and FINRA's official resources.